Okay, greetings, advanced accounting class. This is just a quick review of what we did for acquisition method in case you're still working on that with the homework and encountering any problems. This was what we did in class per se, right from the textbook, this problem, and it's on the PowerPoint, which is where this is coming from. The situation was the purchase was for $2,620,000. That was the fair value. The book value, which we gleaned from the exhibit, was $600,000. We have to explain the difference between the book value and what we paid, and the problem tells us how to explain the difference in the two prices by these different amounts between fair value of what we paid inside, assets inside the company versus the book value inside the company. And the result of the analysis shows us that we can explain everything except $70,000, and we know that from the chapter on the equity method that this represents our goodwill. That's how we'll explain it, and indeed that's what it's called right on here, goodwill. That was step number one. The amount that gets booked to the investment account will be $2,620,000. That will be on the parent's books, since the subsidiary is not dissolved immediately and it stays as a separate legal entity. This investment account will have to be presented as a consolidation because there's control. This is where control percentage is the ownership. And so when we go to do this, the worksheet, we're going to be looking at the accounts that have to be consolidated. On the date of acquisition, there are no income and expenses to report from the subsidiary. So for date of acquisition, this part is just as it is there, a complete zero, and everything here carries forward on the consolidated income statement and the statement of retained earnings. Next, we go to the balance sheet. Date of acquisition does show the fact that there is something that we have to worry about or do something with when the consolidation, because the investment account is there. If indeed what we're doing is combining the assets of both companies for the consolidated balance sheet, then the investment account, to show that as an additional amount, would be superfluous, because inside of here is the $600,000 book value that they bought plus the fair market value above that. That's what's in the $2,620,000, and that market value, or that book value rather, the $600,000 book value, is included right in these numbers here. The net of all these numbers is the $600,000, at least on the date of acquisition. How do I know that? Let me show you. Let's just clean it up a little bit. Do the math. 800 in total assets, liabilities 200, net 600. So the book value amount is right inside the $2,620,000. And if we're going to add these numbers across, which we are going to do, we're going to add all the balance sheet and liability numbers across from the subsidiary, their book value. So if we add it across, then we can't be showing it in the investment account at the same time. We'd be doubling it up. So we're going to take care of that through an entry known as the S entry, which you can see in these columns here. These are the elimination entries. Call it EE. And here's the S entry there. There's the 600 representing the book value on the date of acquisition, and we're taking it out of the investment account. And to take it out of the investment account is a credit. The offsetting debits inside the EE columns is all here. This all adds up to 600, and it should, because those are the equity accounts at the date of acquisition. So it's no different than the 600 calculation that we came up with here, including this. It's no different. These are the net in the accounting equation. Assets minus liabilities equals this over here, and that's why the 600 is included in the $2,620,000. And that's why the S entry takes all that out, and we're really halfway to getting our acquisition date balance sheet. Okay, so to go back now, that means we've done the S entry. Now we need to do the A entry. The A entry represents the fair value net above the book value. And what was that? Well, we were given all that information here on this page, and essentially is, well, not essentially, it is exactly the number you see, $2,002,000. So our A entry is somehow going to involve $2,020,000. Again, it works out perfectly because this is the date of acquisition. So there you go. The A entry is $2,020,000, and when you put that credit in there, along with the $600 that we just did, you wind up with the desired result of 0 for the investment. However, to balance the A entry, which you got to do in the EE columns here, the elimination entry column, you got to balance it. So what we're going to do is take this opportunity to book up or book down, depending on as the case may be, what we know about the difference between the fair value and the book value of the subsidiary. Remember, this is the parent, this is the sub. And so that's what the A entry does. And all these numbers here come exactly from the differential that we saw here. They're all the same numbers. 200, 11, 750, go back, you'll see it's all the same. 200, 11, 750. The difference, which is also included in the A entry, is the goodwill. And the goodwill was also really on there, right there. So it's all these numbers. What I'm circling in blue right now are all the numbers that really make up the A entry on date of acquisition, and that's it. I mean, now you're done. You basically, those are the only entries on date of acquisition. Now you carry everything forward. Just to see, 1 second, just to see what you do. You're doing the following. You're adding across to get your number. And here you add across and take these credits, and you wind up with 0. That's perfect. Right where you want to be, and then you add across, and you're going to wind up getting over here in these accounts, you're going to wind up getting the book value of the subsidiary plus the fair market value on the date of acquisition, which we can do because we now know the fair market value since it was a third-party arm's length transaction, and we're going to include the goodwill upon the purchase. We get a consolidated total assets. This is the liability side, which gets adjusted as we add across, and everything's going to work out perfectly. Notice that when we add this across, it wipes out the equity accounts of the subsidiary, so the only real equity that shows on date of acquisition was what existed on the parent's books at that date. That is basically date of acquisition consolidation in a nutshell. Let me know if you have any questions.